Something happened in the silver market that almost no one is talking about. A price level that took decades to even approach was shattered in a matter of weeks. And now, the analysts who called it impossible are quietly updating their models. But here is what they are not telling you. The forces that push silver to $80 are not slowing down. They are accelerating. And the institutions that understand this are already repositioning before the general public even realizes what is happening. If you have been watching silver from the sidelines, what you are about to hear may change the way you think about this metal entirely. And if you are already holding silver, this analysis could be one of the most important things you watch this year. So stay with us, because the most critical part of this story comes later, and you do not want to miss it. Before we go further, if you find this kind of analysis valuable, hit that subscribe button right now. We cover gold, silver, and the macro forces that drive real money every single week here at Gold and Silver Intelligence. Now let us get into why $80 was never the destination. It was just the beginning. Here is where most people get this wrong. When silver crossed $80, the financial media treated it like a one-time event, a spike, an anomaly, something that would correct and fade. But when you step back and look at the structural forces driving this market, a completely different picture emerges. This was not a spike. This was the market finally beginning to price in realities that have been building for years. Let us start with the supply side, because this is where the story gets uncomfortable. Global silver mine output has been stagnant for several years. Despite rising prices and surging demand, miners have not been able to meaningfully increase production. Why? Because the easy silver has already been mined. Most silver today comes as a byproduct of mining other metals: copper, lead, zinc. That means silver supply is not driven by silver prices alone. It is driven by the economics of entire other industries. And right now, those industries are facing their own challenges. This supply ceiling is not temporary, it is structural. But that is only part of the story. Here is where the situation becomes much bigger. Industrial demand for silver is not just growing, it is exploding in ways that no previous silver bull market ever faced. Silver is now a critical material in solar panel manufacturing. Every single solar panel requires a measurable amount of silver, and the global push toward renewable energy has created a demand floor that did not exist a decade ago. In 2024 alone, solar manufacturers consumed hundreds of millions of ounces of silver, and the projections for 2025, 2026, and beyond show that number continuing to climb aggressively as countries race to meet climate commitments and energy independence goals. Now think about what that means. You have a commodity with a supply ceiling colliding with an industrial demand curve that only goes one direction. Most commodities experience this at some point, but silver is experiencing it at a moment when something else is happening simultaneously, something in the financial system that very few people are connecting to the price of silver. Here is where things get interesting. Central banks around the world have been quietly losing credibility. Not all at once, not in a dramatic collapse, but in a slow structural erosion that has been building since the financial crisis of 2008 and accelerated through the pandemic-era money printing that followed. Trillions of dollars in new currency were created, and the consequences of that creation are still working their way through the global economy. Inflation may have moderated in the headlines, but the purchasing power that was destroyed does not come back. And sophisticated investors, the ones managing serious capital, understand this. When they look for protection, they look for assets with real, physical, undeniable value. Gold has historically been that asset. But here is the detail most people miss. Gold has already repriced significantly for this reality. Silver has not yet. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged somewhere around 50 to 60 to 1 over long periods of market history. In recent years, that ratio has been dramatically elevated, sometimes reaching 80, 90, even over 100 to 1. What that ratio tells you is that silver has been historically undervalued relative to gold. And when these ratios mean revert, which they always do, the movement in silver is extraordinary. Let us put some numbers on that. If gold is trading around $3,000 per ounce and the ratio normalizes to even 60 to 1, which is well within historical norms, that implies silver at $50. If the ratio returns to 50 to 1, silver at $60. But here is the part that should get your attention. During true monetary crises and silver bull markets, the ratio has historically compressed far beyond historical averages. In 1980, at the peak of the last great silver run, the ratio briefly touched approximately 20 to 1. No one is calling for a repeat of 1980 exactly, but a compression toward 40 to 1 during a sustained monetary instability would put silver well above $100 even at current gold prices. And if gold itself continues to rise, which its own fundamentals strongly suggest, then the math becomes even more compelling. Now here is the detail most people miss when they see these projections. The move to $150 in silver does not require some catastrophic collapse of the financial system. It does not require hyperinflation or a dollar crisis. It simply requires the continuation of trends that are already in motion. Industrial demand continuing to grow, mine supply failing to keep pace, institutional and retail investors allocating even a small percentage of their portfolios to precious metals as a hedge against monetary uncertainty, and sovereign nations, particularly in Asia and the Middle East, continuing to diversify their reserves away from dollar-denominated assets. That last point deserves its own moment, because it is one of the most significant macro shifts happening in the world right now. Countries that once held the majority of their reserves in U.S. Treasury bonds are quietly, steadily, building positions in gold. And as gold becomes more expensive and more strategically held at the sovereign level, silver, which is gold's historically linked partner but at a fraction of the price, becomes increasingly attractive to the second tier of institutions and investors who cannot afford to build large gold positions but still want hard asset exposure. We are already seeing this play out in the derivatives and futures markets. Open interest in silver contracts has been rising. Physical delivery requests have been climbing. The ratio of paper silver claims to actual physical metal held in vaults has become a quietly discussed concern among serious precious metals analysts. What that means in practical terms is that the silver market, for all its multi-billion-dollar daily trading volume, actually sits on a relatively thin physical supply base. When demand pressures build rapidly, that thin supply base becomes a serious issue very quickly. We want to hear from you on this. Drop a comment below. Do you think silver reaches $150 within the next 2 years? Or do you think something changes the trajectory before then? Let us know your thinking. Here is what happened next that changed the calculus for many analysts. When silver broke through $60, the majority of mainstream forecasters still had their year-end targets in the $50 to $55 range. When it crossed 70, the targets were hastily revised. When 80 was taken out, something shifted in the professional analysis community. Institutions that had been underweight precious metals began quietly increasing allocations. Not because of a single dramatic announcement, but because multiple models across different analytical frameworks were arriving at the same conclusion. Silver was underpriced relative to its industrial reality, its monetary role, and its historical relationship to gold. That kind of convergence, when fundamental analysis, technical analysis, and macro positioning all begin pointing in the same direction, is precisely the kind of environment where markets make large, fast, sometimes shocking moves. Not the slow, grinding appreciation that most people associate with commodities, but the kind of move that, looking back, seems obvious in retrospect, even though almost nobody was positioned for it at the time. The question now is not whether silver goes to 150. The question is what the path looks like and how fast it gets there. And here is the scenario that most analysts are currently modeling as the base case. A continued environment of monetary uncertainty, combined with persistent industrial demand growth driven by the green energy transition, causes silver to grind higher through the rest of this year. A catalyst, whether it is a Federal Reserve policy shift, a significant geopolitical development affecting supply chains, or a visible squeeze in physical silver availability, causes a sharp acceleration. And the market, which by that point has already been moving higher for an extended period, sees a rush of late-arriving capital from retail investors who finally realize this opportunity is real. That last wave is always the most powerful, and it is always the one that takes prices to levels that seemed impossible just months earlier. The evidence is already accumulating. The supply dynamics are real, the industrial demand growth is real, the monetary environment is real, the historical undervaluation relative to gold is real, and the institutional shift in sentiment is real. Each of these factors alone would be significant. Together they form an argument that is difficult to dismiss. Now here is the final piece of this picture that most people never think about. Silver is the only asset in the world that is simultaneously a precious metal, an industrial commodity, and an emerging critical resource in the global energy transition. It occupies a position in modern economics that nothing else does. And that uniqueness, that structural irreplaceability, is something the market is only beginning to fully price in. The move from $80 to $150 in silver is not a prediction that requires perfect conditions. It is simply the logical continuation of forces already in motion, if those forces are allowed to play out. And based on everything we can observe right now, there is very little standing in their way. So the question we leave you with today is this. When the market fully wakes up to what silver's combined role in our economy actually means, the monetary role, the industrial role, and the energy transition role all at once, where do you think the ceiling actually is? Think about that carefully. And if this analysis opened your eyes to something you had not fully considered before, share this with someone who needs to hear it. The information is only valuable if it reaches people before the move happens, not after. Hit the like button if you found this analysis useful. It genuinely helps us keep producing this kind of content. Subscribe to Gold and Silver Intelligence if you have not already, and turn on notifications so you never miss an update when the market moves. The next few years in precious metals are going to be ones that people talk about for a generation. Make sure you are watching closely.